In 2019, I made a video looking at the history of the SeaWorld chain, how Blackfish nearly sank them, and how they were coming back with a whole new business model, focused on roller coasters. The future looked bright, and 2020 was gonna be their year, with a major new coaster set to open in all 5 of their major parks. Needless to say, the coronavirus came at the worst possible time, and suddenly, the rosy picture that I painted for the SeaWorld Entertainment Company a year ago wasn't so pretty. And the pandemic may have uncovered some underlying issues aside from the obvious. What's really going on with SeaWorld? Let's take a look inside. There's no doubt that it's been a long road back for SeaWorld ever since Blackfish. Their stock tanked in August of 2014 and rarely cracked $20 per share until the rebound that kicked off in early 2018. Right around the time that CEO Joel Manby resigned after 3 years at the helm, and John Riley took over on an interim basis. Manby knew that the company needed a new identity following Blackfish, and orchestrated the transformation that we see today. Wine festivals, parades, Sesame Street theming, and thrill rides. It was a much needed change that started paying off right as he was headed out the door. So why did Joel Manby leave? Apparently, the same reason that SeaWorld ended up with 5 CEOs in a 2-year window. A bad relationship with the board of directors. More specifically, Scott Ross, the founder and managing partner of Hillpath Capital, who had been gaining more and more influence in the company since 2015. And in July of 2019, Ross became the chairman of the board. SeaWorld hired Gus Anshorta from Carnival Cruises in February of 2019, and he was out by September, citing disagreements with the board as his reason for leaving. Sergio Rivera took over in November 2019, but he was gone by April. Again, citing disagreements with the board of directors over how they were treating their employees during the COVID shutdown. Scott Ross was calling the shots here. Some may even say that he was micromanaging the company, and this didn't sit well with the incoming CEOs. Remember Scott Ross and Hillpath Capital. He's the major force driving the present and future of SeaWorld. It wasn't long after Scott Ross took over as chairman of the board that the company started slashing costs at the expense of company morale. SeaWorld's corporate financial reports were successful in September 2019, but they turned around and fired 100 call center workers in Orlando in order to outsource their jobs to other countries. 4 months later, they outsourced their Midway games to a British company, and those employees had to reapply with their new employer, or else get a severance package and look for another job. These were questionable moves, but the chain was looking forward to a massive year. 5 standout coasters at their 5 major parks. The price tag for everything together easily surpassing the $50 million mark. But by mid-March, all of their parks were shut down, and just a couple weeks into the closures, furloughed 90% of their workforce. No pay, no benefits. This was while Universal and Disney were still committed to paying their staff. The next month, their 7 remaining top executives took a 20% pay cut, but were given $7 million in stock rewards over the next 2 years if they committed to stay with the company through 2022. But the most striking news story to come out of SeaWorld in 2020 came in June. Despite the company repeating over and over again that they had enough cash in hand to get through the end of 2021, they stopped paying their contractors. Just in Orlando, 56 liens were filed against SeaWorld, totaling around $16 million. And it was a similar story in Tampa and San Diego. RMC was looking for $3.5 million of the $9 million they were owed for Iron Gwazi. Premier Rides was short $2.7 million of the $8.2 million for Icebreaker. Balfour Beatty Construction filed 2 liens for a total of $6.1 million for projects at SeaWorld Orlando and Aquatica Orlando. Just for reference, in all of 2019, only about 10 liens were filed for about $1 million. Liens are just a claim on the property to ensure the debt is paid. It's not necessarily a legal challenge. But things were a little more serious in California, where Level 10 Construction accused SeaWorld of not paying them millions of dollars and knowingly breaching the contract, owing the company $3.3 million of the $11 million for Emperor. This was all happening as the chain was borrowing extra money to increase its cash reserves, exceeding $400 million by the end of April, and claiming 18 months of cash cushion. So why was SeaWorld stiffing their contractors? Joe Kleiman is an editor at In Park magazine, and came up with a theory that explains these actions. The company was contemplating filing for bankruptcy. If you look at this from the standpoint of Scott Ross and Hillpath Capital, they became heavily involved in SeaWorld back in 2015. And just a year later, a deal was struck to bring a SeaWorld park to Abu Dhabi in 2022. In 2017, it looked like the chain was going to expand into China. But that fell through when they lost the investment from the company that owned the land where the park was going to go. Despite this blow, they were full speed ahead on their new strategy to rebuild their brand on thrill rides and other attractions that had nothing to do with marine animals. But with COVID setting parks back years, if not decades, Scott Ross and Hillpath may be looking at the long road back to profitability and want to bail out now to get the best possible return on their investment. The fact that SeaWorld was looking to sell some of their animals also supported this theory. The fewer the animals, the lower the set costs, the more appealing the parks would be to buyers. Moreover, if the company went into bankruptcy, it would be a lot easier to break up the chain and sell the parks piecemeal to different buyers. This theory makes it seem like bankruptcy is a choice. Other analysts think that bankruptcy for SeaWorld is inevitable. An article from late September on Seeking Alpha analyzes the company's debt and thinks the risk of bankruptcy in the foreseeable future is real. One of the reasons is their cash to debt ratio, which is the company's cash flow from operations compared to its total debt. A higher ratio indicates a company's ability to pay off their debt, and companies often shoot for about 66%. SeaWorld checks in at 18%. Their balance sheet is over-leveraged, meaning they had taken on too much debt. It's not unusual for a theme park to be over-leveraged, but normally, they can show their lenders how much they're growing, and then refinance their debt. With a bad economy and limited capacity, and the fact they're operating with negative margins, they're forced to raise additional debt at higher interest rates, and hope for a quick recovery that's not guaranteed. They raised $500 million of secured notes in July, but owe 9.5% interest on them. Just looking at the second quarter of 2020, their parks notched a total of 98 operating days, compared to 900 during the second quarter of 2019. Those 98 days brought in 300,000 guests, falling short of their second quarter 2019 numbers by 6.2 million. The first half of 2019 saw $171.6 million in revenue, and during 2020, in the same time frame, they suffered a net loss of $187.6 million. Their stock is slowly recovering. After hitting a high of about $37 per share on February 14th, it tanked all the way down to $7.46 on March 18th, but is inching closer to the $30 mark as of December. Still, they're burning $20 to $25 million a month, and that doesn't even include the millions in severance packages for the employees that they had to permanently let go. The bottom line is that they have a high debt load, limited capacity at their parks, and they continue to bleed cash. This is a recipe for bankruptcy. Since that article came out, SeaWorld reported a third quarter loss of $79 million, as well as an attendance drop of 81% from a year ago, despite being able to partially open 10 of their 12 parks by the end of September. They're expecting financial year 2021 to bring in $365 million in revenues, and recover up to $940 million in financial year 2022, which is still short of financial year 2020, where they collected $1.4 billion. But here's the real gut punch. If they declare bankruptcy, their debt holders don't want to be left empty-handed. During the bankruptcy hearings, these debt holders may be awarded some of SeaWorld's assets, including real estate, and the land the parks sit on may be more valuable on their own without the parks on it. It certainly opens up the possibility that some of SeaWorld's properties may be repurposed under new ownership if they choose to do so. I don't know how likely this is, but it's definitely not out of the question. It wouldn't be the first time that property has changed hands, and an entire park was razed because of it. Back in August, CEO Mark Swanson indicated that SeaWorld may use some of their cash reserves to acquire indoor parks, water parks, or hotels that don't survive the COVID shutdowns, a cheap way to expand their reach into different markets. This was a different approach, but definitely an opportunistic one given the circumstances. The new park in Abu Dhabi will also take a different approach from the American parks, being focused more on marine life than thrill rides. Bankruptcy or not, look for SeaWorld to change their focus once again. Maybe they'll try their hand with a large quantity of inexpensive but profitable properties, in addition to their huge parks with multi-million-dollar investments. Or maybe Joe Kleiman from In-Park Magazine and Seeking Alpha are right, and the company is on a collision course with bankruptcy. Maybe Scott Ross is looking for the quickest way to cash out on Hillpath's investment, rather than wait around for the recovery of the amusement park industry. These are the facts. Where SeaWorld ends up, only time will tell. Texas Stingray opened up to the public in February, but the other 4 coasters will be making their grand debut in 2021. And with the COVID vaccine being rolled out as of December, they could turn it all back around. That seems like a good way to end this video on a positive note. Let me know what you think will happen to the SeaWorld Entertainment Company in the comments below, and what their best course of action should be given their current financial situation. Again, Thanks to websites like Seeking Alpha, the Orlando Weekly, the Orlando Sentinel, In Park Magazine, and Screamscape for all the great work they've done tracking SeaWorld over the years and making this video possible. If you enjoyed this video, be sure to drop a like. That's the best way to show your support for the channel. And subscribe if you want to see more theme park and coaster content. It really helps me out, and I'll do my best to keep you entertained. Thank you all for watching, and I'll see you all next time.